Hey, Bulls and Bears, we are back with another dose of economic reality. It is April 20th, 2023. Today is Thursday, and we've got a lot of good news to get into as usual. And things are starting to speed up as far as this economic collapse goes. I've always referred to this as a slow motion economic collapse. Of course, anything can happen where you wake up and something broke overnight where there was a malfunction or a glitch of some sort, everything went dark. There's always the risk of that black swan situation popping out at any point. But other than that, we've always referred to this as a slow motion collapse. They're not going to raise rates so rapidly to cause a overnight collapse that happens within a few weeks or a few months. It's going to be steadily slow motion decline, but the motion of this collapse is actually accelerating as the pool of buyers is drying up. We're going to talk about what that means here. But first, subprime car loans. There's subprime car lenders pausing their lending, and even some big name players in car financing are pulling back from lending. So I think they see the writing on the wall. They see the warning signs out there with the bank failures and everything else happening right now with the amount of debt that people have. The amount of debt that people have, it's amazing that people are still qualifying for car loans the way they are. I still look at my local car lot. I drive by and try to visualize, how many cars I see from week to week. And it doesn't seem to be increasing, right? So it seems like they're still selling a lot of cars, or at least enough to not have their inventory pile up, anyways. And I've also been keeping an eye on a few different dealers online. Certain dealers will give you their total inventory that they have. So there's a couple here in San Diego that I look at, and they haven't really been surging, like many had expected. And I didn't really expect that either. But they have been increasing very slowly. But I think that's going to start happening more rapidly here. Take a look at some of these articles here. Starting with Capital One. Capital One shut off all dealer floor plans. That is a mechanism of financing. USA Auto Sales shut down 39 dealerships after losing its Ally financing, or what they call a floor plan. Wells Fargo laid off all its junior auto loan underwriters and capped future loans, right? So things are changing. This tightening of credit is really accelerating. And it's going to be a few weeks before this plays out here to see if this really has an impact on vehicle inventories, for example. But also, when credit cards start restricting their credit limits, you're going to see a lot of changes in the economy, a lot more layoffs, because less people spending money in the economy equals less jobs. And we could really see the layoffs accelerate, even though they're already bad. They're already about 5 times this year what they were in 2022 at this point during the year, just about a little less than 4 months into the year. But I think that's going to accelerate and get much worse. In fact, we had a number that just came out earlier today. U.S. jobless claims rise higher than expected. Well, I'm not sure who didn't expect this, but 245,000 new unemployment claims. Add that up, that's almost a million per month. Now, yes, a lot of these people go out and get different jobs. So then they'll put that in the jobs added category, trying to paint a good picture of what's happening right now. But a lot of these new jobs added are just people that got laid off or fired or quit, getting different jobs. You see how this works? So very interesting what's happening right now. And I think, again, it's going to accelerate. Reuters, U.S. labor market cooling, leading indicator, flashing the R word. Continuing jobless claims rose also. Existing home sales fell 2.4%. Also, prices dropped in housing. Sales slid, but also home prices dropped. And this was the biggest price drop in a decade, in about 10 years. And this wasn't a huge price drop. The median price of an existing home or used home fell 0.9% from a year ago. So that's not very much, less than 1%. Just like I said, it wasn't going to be a crash, right? I've said that here time and time again. But it is, even that small drop was still the biggest decline in prices that we've seen in about 10 years in U.S. real estate. A year earlier, prices dropped to $375,700. And that was the largest decline since January 2012, so a little bit more than 10 years. Folks, these tightening credit conditions are going to make it very interesting and what's going to happen with the cost of living and prices in several different areas of our economy. We have these inflationary things happening with the de-dollarization, which we talk about quite frequently here, um, the money printing, but at the same time, we have the Fed pulling back on their purchases. Their balance sheet is again dropping. Therefore, lenders aren't able to offload all these bundles of loans like they could in the past. So naturally, we're going to see this credit contraction or restriction of lending. And add on top of that, the bank failures, all the uncertainty about the backing of depositors. It has everyone from businesses to individuals being very cautious right now. And we saw that a few days ago, where we looked at that survey that said about 70% of people were feeling very negative about the economy. Also, let's go back to home prices here for just a minute. We had this home buying program implemented here in California. It was supposed to help people buy homes. It gave people money for a down payment. That has already been drained. It was called the California Dream for All Home Down Payment Program. It ran out of money in just 12 days. So that's how desperate people are here to try to get assistance to buy a home. And I think it's a crazy time right now to be trying to buy a home, but people drain this within 12 days. Demand for California's new down payment assistance program overwhelmed the system and depleted its $300 million budget in less than 12 days. 300 million doesn't go a long ways here in California with the home prices the way they are. But for so many people to be that desperate to buy a home to drain this within 12 days just shows you the desperate times that we're in. I mean, people feel like they have to buy a home right now with what's happening with prices and what's happening with the banks. Would you feel like you would be desperate to buy a home right now, or would you want to take a wait and see approach and maybe, kind of take a step back and just sit back with your popcorn and watch all this unfold to see how it's going to play out, right? I wouldn't want to make any big ticket purchases right now. Not that it would really hurt me that if prices dropped, I bought a home and prices dropped, or buy a vehicle and prices dropped. Not that that would wipe me out or anything. Not that I'm a millionaire, but um, I just don't like to waste money. Even when it comes to the house here, I'm always shutting off lights, and you shut off a light for 20 minutes that shouldn't be on. It's probably not a big deal at the end of the month. It's probably not going to make that big of a difference in your electricity bill, but I just hate. So I just hate. I wouldn't want to go out there and buy something right now, knowing all the uncertainty that we're in a credit crunch, that lending is tightening. And what happens when lending tightens? Well, less people can get qualified for loans. That means less cars getting bought off the lot. That means less homes selling. And we're seeing a lot of that right now, actually, not just because of the high interest rates, but because of the tightening of the lending. And even these programs that we're trying to help people in here in California, here, that example that we talked about, that was drained in just less than 2 weeks. So they're going to have to throw a lot of money at this to keep things propped up, and I don't think they're going to be able to do it, or they do not want to do it. Obviously, they're keeping rates high. They're talking about more rate hikes here out of the Fed in their attempt to fight inflation. It really hasn't helped that much because inflation, although it has the rise of inflation has slowed down, it's really not making a dent in most people's budget. Another recent headline here that caught my eye: biggest banks wrote off $3.4 billion in bad consumer loans. A lot of these banks have bad loans on their books. The buyer and lender of last resort may not be there to take these bundles of loans or these bonds or securities off of the books of these lenders. So we're going to see how this plays out, but things are looking like they're definitely accelerating to the downside here. This economic collapse is going to be very obvious to even the casual observer here. I think very. Also, we are seeing some disappointing earnings. Look at Tesla. Shares of Tesla dropped about 8% after the electric vehicle maker reported lower than expected gross profit margins. We also see AT&T. They missed their first quarter revenue expectations. We also have American Express. The credit card company also had mixed results in their earnings, right? So it's not all boom time anymore. So we're starting to see a lot of signs that this economy is taking a quicker turn. It's definitely not going to be a collapse, I don't think, but things are accelerating to the downside much more speedily. So we're going to continue to, I think, find more signs every day. There's more layoffs here. And I've got a few other things I want to put together for my next report. So we're going to bring that to you here. But first, let's talk about a precursor to just about every economic downturn for the last 50 years, and that's the inverted yield curve. And it doesn't always, the economy doesn't always plunge when the inversion happens, but when it comes out of reversion, that's usually when we see finally the acknowledgement out of mainstream business news that there is a severe economic downturn. So we're headed in that direction. We've been inverted here for a while, and it usually doesn't take more than 6 months to a year. So I think we're definitely within the coming few months, we're going to see some big things happen. Big things have already happened. I mean, look at the bank situation. Look at the levels of debt. Look at the despotism with the people needing free rent in cities like LA and other cities where you might have 750,000 people become homeless. We just talked about that a few reports ago. So we're going to see some wild things happen this year. More people desperate, more people breaking in, stealing things, robberies, unrest, you name it. It's gonna accelerate, folks. All right. So be careful out there. Eyes in the back of your head on a swivel. Be safe. Be aware of your surroundings because it could get dangerous as people get desperate. People start missing meals. It's going to get very, very precarious times, right? So hope everybody's good. Keep stacking, folks. We'll see you next time. Thanks for being here.